Hello, welcome again. Let us start our video with the famous quote from Benjamin Graham. In the short run, a market is a voting machine, but in the long run, it is a weighing machine. In this video, we'll touch upon volatility concepts and understand its importance for the option seller. One of the three main factors affecting the value of an option, as we mentioned previously, is volatility. Volatility evaluates how rapidly and how significantly the option value is moving in relation to the underlying asset. Normally, underlying market that are producing significant moves to the upside or downside or are being subjected to a large or rapid daily price variation will produce options with greater volatility and thus higher price option. Slowly changing or quiet markets normally will generate lower valued option. Volatility is calculated by a figure known as option delta. We'll look into option delta in the next video. In our opinion, if you can use a slight knowledge and a lot of common sense just to pick a price level of where the market will not go, volatility becomes less important. We are not, however, indicating that you ignore options volatility completely. Volatility is often calculated using variance and standard deviation. The standard deviation is the square root of the variance. Let us quickly understand how to calculate variance and standard deviation in Excel. First, find the mean of the data set. This means adding each value and then dividing it by the number of values. If we add 1 plus 2 plus 3 all the way up to 10, we get 55. This is divided by 10 because we have 10 numbers in our data set. This provides a mean or average price of 5.5. Calculate the difference between each data value and the mean. This is often called as deviation. For example, we take 10 minus 5.5, it will give 4.5. Then 9 minus 5.5, it will give 3.5. This continues all the way down to our first data value of 1. Negative numbers are allowed. Since we need each value, these calculations are frequently done in spreadsheet. Square this deviation. This means eliminate all the negative values. And the square deviation together in our example equals 82.5. Divide the sum of the square deviation, that is 82.5, by the number of data value, that is 10. You will get 8.2, which is called the variance. In order to get the standard deviation, you need to take the square root of variance, that is 8.2. This gives us a standard deviation of 2.87. This is an important concept in option selling, as standard deviation is quantity expressing by how much the members of a group differ from the mean value of the group. If prices are randomly sampled from a normal distribution, then nearly 68% of all data values will fall inside one standard deviation. 95% of data value will lie within 2 standard deviation, and 99.7% of all values will lie within 3 standard deviation. Standard deviation is still commonly used by traders, as price return data sets often be similar to more of a normal distribution. Thank you once again for watching the video. Happy learning.